Markets are still keeping a slight hope of a July cut on the table ahead of Friday's PCE number. You see that little 10% probability there on the left of your screen. But my next guest says, given how persistent inflation has proven, he wouldn't be surprised to get a hike before any cut. And because of that, in part at least, he's avoiding tech and playing a bit of defense. Joining us is Philip Palumbo. He's CEO of Palumbo Wealth Management. Going out on a limb here, Phil, why?
Yeah, so coming into this year, I've been consistently saying that I thought markets would perform well, as they have been, simply because earnings are going to accelerate this year and in 2025. And we're probably closer to the end in terms of this Fed hike cycle than the beginning. However, as we've seen, inflation has been persistent and it's been sticky, especially on the services side. And we're a services economy. And when you got an economy that continues to perform well, as we are seeing, and you got stimulus, fiscal stimulus still coming into the economy with the different acts that were passed, it may be tough to get services down. And inflation is the number one threat to low-income households, retirees, and really for the overall economy. So I think the Fed is right by holding off. The problem is that he may hold off too long or at some point make a mistake, and that's the biggest risk that we are all exposed to as investors.
A lot of people have kind of correlated tech reigniting with these expectations for a rate cut, so you're not among them, and I imagine that's why you're not a big fan of that trade.
Yeah, so Kelly, I look at opportunities where you got fair market value and what's trading below fair market value. And that's something that I'm looking at on a continuous basis. So if you look at the tech sector, which is great and it's done well, and those are phenomenal businesses that will continue to do well over time, it's just that they're overpriced for what we're looking for. And I think for any investor, it's like buying real estate at a 1 cap or a 2 cap. Nobody would do that. And that's kind of where we're at with technology. But if there are other areas of the market that looks attractive.
I mean, I know some people who will buy it at a 1 cap or a 2 cap and just think, well, prices never come down. I forget what happened last time. Okay, so you're looking at REITs, you're looking at utilities, some specific stocks like Entergy and also Nike. So do you think that stock selection and specific stock holdings is the way to go here? Are you trying to sort of sector time and ride this out?
Yeah, so we have, like we've all been talking about, right? So we have a very narrow market in terms of performance, and I do think that can broaden out. And if it broadens out, if you take a look at utilities right now, that whole sector is trading as cheap as it did back in 08, 09. It's down because of the pressure of rising interest rates. But when you think about that sector, as we think about technology, there's going to be an increase in electricity demand that could rise 2 to 3 times over the next 5 years. And Entergy in the southeast area over there is one particular business that could really thrive. Now, if you look into energy, they're working with companies like Amazon, who's building a $10 billion data center down there, Google and Meta. They have some of the lowest electricity rates there. They're putting together a $33 billion capital investment over the next 5 years. And it's trading right now at a 15% discount to fair market value, dividend of 4.2%, just got an increase of 6% most recently of their dividend. So for me, I just think the risk reward makes more sense in that space than in technology.
I'll just point out the irony that you don't like technology because of rate hikes, but you do like REITs and utilities, which traditionally do the poorest in that situation. But I think it comes back to what you said earlier, which is it's really all about valuation. So it almost makes me wonder, is this even about the Fed at all, or are you really just looking at valuations in the market and sticking with what you think is undervalued?
Yeah, Kelly, the best advice I can give your audience really is that the timing of interest rates, the timing of the economy and markets is really a waste of time. The best thing you can do as an investor, just like I mentioned before, looking at real estate with caps, market caps, or cap rates that make sense at 6%, 7%, and same thing with investments in businesses, right? You're investing in a business that you do the work on intrinsic value, what's it trading at, if it's trading below intrinsic value, high returns on invested capital, lots of free cash flow. And you're patient, which is the edge that we all have as an investor. That's what's going to make the difference over a 3 and 5 year period. And that's just how we look at it here.